N Jayakumar joins us, Managing Director with Prime Securities. Jake's just been one of those patches where no one is interested now. I mean, the bulls are saying, look, we've lost enough money, we don't have capital. The bears are saying, how much short can we go? Because there's a limit to which markets will go down.
Well, I think it's much more than that. The reality is that you've actually driven large trader interest completely out of the markets. Now, whether it's in terms of, just the way the trend is. See, for the first time, I think the Nifty is so far removed from reality, whether it's the economy or the market as a whole or portfolio valuations of any kind, that I think the interest levels have just, today you're seeing the Nifty, the dissonance is even higher because you're ostensibly 5% away from, all-time highs and lifetime highs. You expect, if not exuberance, some degree of, wellness or well-being. But I think portfolios are not reflecting it. And, this difference is only getting, even more intensified as the days go by. So once that kind of interest goes out, stocks are just finding any levels of any kind. I mean, there's no relationship between value and what stocks can go to. But I think it's also reflecting, and maybe it's a long answer to a short question, but it's also reflecting the underlying, if I may use the word malaise in the economy, which is that, you're seeing numbers that are, for the first time, I think you're going to see quarterly earnings that are going to show degrowth in many, many sectors. Forget low single digits. I always believe that low single digits may be a euphemism for degrowth really. And when you have large FMCG majors announcing profits compared to last year, which are 1 lakh and 10 lakhs higher than the corresponding, you almost know that they're just trying to keep that growth going. So I think there's a serious problem. I think many pillars of the economy have been badly beleaguered. Everybody's talked about the NBFC, so I don't want to be a broken record early in the morning, but the reality is everything in life, whether it's the credit markets or equity markets, goes on two factors: willingness and ability. Ability is when you actually see money in your pocket and you want to spend, and willingness is that you feel like spending, and that willingness to spend today is not there because there is no feel-good factor, and the availability of credit is just not there. So even if you wanted to spend on credit, similarly for the corporate space, which is that industrialists, rarely differentiate between equity and debt. If money is generally available, their ability to, reinvest further, whether in terms of marketing or capex or whatever, continues. Today, you're having pullback across all fronts. Debt has become a terrible word in a scenario where debt rates are going down.
So what you're saying is that bad will get worse before it gets better, because we've just started slowing down. We've had good years of consumption growth. We've had good years of growth in terms of availability of cash. The slowdown has hit autos, consumer, and now the real economy, which means we are looking at more bad news, more slowdown, more crack, perhaps lower prices before they start going higher.
I have prided myself in being a perma bull. And
but these are different circumstances.
But the tag sort of comes back to bite you, as it were. And one almost feels terrible saying this, but I think the good news, if any, is that the bad news is coming very quickly. So if you want to take solace from something, it is that this is not going to be a protracted 4-year kind of slowdown. This is going to be very brutal, as indeed it is. And if you see the corporate space, and I keep looking at everything by saying liquidity ultimately drives sentiment. Liquidity drives a lot of things. And today, when the corporate space, mid-cap companies which have been icons of the sort of mid-cap tag and they've grown, etc., are now literally pariahs of today. So in that kind of a scenario, how do you, engender confidence? How do you bring about? I think this is a much more deep-rooted, it's almost an exercise in psychology as much as it's an exercise in real life cash flow. And, I'd like to believe that I like to see silver linings and maybe, have been sort of branded as being, as I said, a perma bull. But the reality is, I think it's a very scary scenario. And, the NBFC has been virtually accounting for 1/3 of the entire credit is now a wheel no longer available. People have been clamoring for interest rate cuts, but there is no transmission. So what's happening is the government can conceptually borrow cheaper and cheaper, but the actual corporate who needs money is finding it extremely challenging getting money. Now you could say that, the two HDFC twins and the two Bajaj twins are fine and, market share will be taken up. But an economy like India, are you telling me that the entire slack of the entire NBFC space will be taken up by 4 people? I think it's kind of, I've heard these kind of comments to justify valuations of some of these. Maybe people can use any logic to justify, and flow of liquidity is the ultimate thing that justifies some of these valuations. But really speaking, the slack has to be taken up by the banking sector as a whole. So it's not, I think the real issue is transmission. And I go back to the same example of the TARP in the US, where toxic assets were pulled out, liquidity was given to people, notwithstanding how they were created in the first place. And that liquidity then started moving through the economy. It's not good. Today, the same willingness and ability argument. Go to the banking system, go to the PSU space, which is a large space. Do they have the willingness to lend? No. Do they have the ability? Yes. They are awash in liquidity. There are PCA banks that I'm aware of, which have got liquidity of 45,000 crores on their balance sheet, which means they've got the ability to lend, but there's no willingness.
So what is the next layer? We've discussed bad news. We know the cause. We know the symptoms. So there are two ways to look at it. Like you said, this is not a prolonged slowdown. So what will change?
I think what will change is, and I thought the actual change would come through foreign capital rushing to find solace in distressed assets. Of course, this tax has been more than just a speed breaker. Yeah, it's more than a speed breaker on a highway. It's much more than that. So when you are at a stage, and I'm trying to conceptually go through the government thought process in this, when you're trying to get capital from outside, which is the capital that will come in, they are not afraid of stressed situations, etc. And again, I go back to something that my dear friend Rashesh says, which is that in India, there are no stressed assets. There are stressed promoters. So you need to have situations where the money can come in. Now, have we in some sense, narrowed the sieve or made the conditions even more difficult for money to come in with this tax treatment? Is there some thinking, that India is the place to invest in? Do people have a choice? Now, when these questions are asked, I get a little bit worried. It's almost as if saying, so somewhere along the line, I think the commentators from overseas came in and said that maybe this was unintended. This tax was the fine print sort of covered them when it was not intended to.
Yesterday's comment in the parliament is saying that it was planned and overthought.
That's
correct. Not an oversight.
Now, when that happens, then you feel, that there's something wrong, that you're attracting capital. At this time, had the government turned around and said all foreign money can come in at 5% cheaper tax rates, I would have said, wow, that's bold. Are you pampering them too much? But that's where the capital is coming from. And we would have lived with that. But to say we're going to tax higher and we were aware of it, if indeed that is the argument, I don't even know if it is. I think that's kind of, I don't know if you're kind of biting the hand that's going to feed you, but that's capital that's going to come in. So there's something amiss, and I'm not, maybe the sector, this will be one massive catharsis. Corporates will die and, new ones will be born. Maybe that's the sort of George Orwellian, Brave New World that, we are staring at. Who knows? So, but just to sort of add a point here, but the stress that we are seeing is now coming through even, and, people don't realize that when the same sector you've been lending to, you stop and say, I will do no further lending, which means projects are left incomplete, residential complexes are left incomplete, then you're actually enhancing the NPA even more and exacerbating that situation. So I think there is no option but to continue this thing, and maybe if there is something called a gradual slowdown, you need to get there. But I think today, if you ask me, maybe the horses are bolted.
I appreciate the fact that you're being so upfront about the situation.
Well, there's no other option, right? There's no other option. This is, if I said anything else, I'd be doing disservice to myself. Never mind to a few people who will, sort of hear you.
Our common friend Rakesh Jhunjhunwala says that, look, I've made 98% of my wealth by being bullish. You have to buy bad news.
Correct.
But the problem is that every time people have rushed out to bad news, they've only lost more money. What we are trying to understand from you is that, let's say on a 3-year time frame, at this level, if somebody takes a brave and a contrast step to buy more or even to hold on and not to sell, not selling also, I think, is a contrast in this market. What is the upside and what is the downside?
So this is the first time in this discussion we talked stock markets, right? Which is to say, have markets factored a lot and more? Excuse me. And I think the answer could be yes, that individual stocks have gone to bankruptcy pricing. So it's like ILF is moving from AAA to D in 2 months. That one day you're everybody's darling, the next day you defaulted for a single day, the one day default made you a candidate, adequately positioned to be a D. Similarly, these one-day delays which typically happen when corporate cycles go bust, it doesn't mean the businesses have gone. It means there have been delays. Now, delay doesn't mean you put a bolt and keys and sort of shut down the shop tomorrow morning. It means that there's a protracted period of restructuring, etc., etc. Markets tend to price them at bankruptcy almost instantly. So I dare say that in the spaces that where people are hiding, which is the consensus trade of 60 PE stocks or 70 PE stocks, and the feel good two tech companies, couple of FMCG companies, couple of the 2 H's 2 B's kind of thing, I don't think you're going to make supernormal money in that. Yes, I think everybody's being painted with the same brush. So if you had capital that you can put away, maybe from a 4-6 quarter kind of perspective, forget 4 years, 5 years is too long, and that could be my disclaimer to say it's 5 years, we've not come to it, we'll wait and see. But over a 4 to 6 quarter period, I think returns could be interesting. But then, do I have the willingness and do I have the ability? I think both have been impacted. I think therein lies the issue. So the other way that markets bottom out is when nobody has the ability to buy and the willingness has been smashed to bits. And I think today we are very close to that climatic bottom in terms of large swath of mid-cap stocks that potentially are bottomed out, but time-wise could take a lot more effort before they sort of show traction. That's the way I would like to look at it.
So the natural question is where you see that opportunity.
I'll come to that in a second. I think the important thing is, and what can the government do? I think the question was asked, and we can all be critical of, is there something that they can do? And I go back to another comment that I've actually made, which is that no favors, no hand-me-downs. Can the government merely instruct every single government agency that deals with the private sector party to make their payments on time? Which means whether it's state electricity boards, whether it is national, NHAI, the various tax refunds. Tax refunds, by the way, is a huge amount. Even if that amount came back, without the kind of loops that one has to go to, for want of a better euphemistic word, on how refunds come back to you. If some of the monies that the various public sector counterparties pay you on time, to my mind, that itself will add some kind of a 1/4 of a potential quantitative easing that you could think of. Today, the problem is people are jammed. Even when the ILFS thing first happened, the first thing they said was 15,000 crores is owed from NHAI. NHAI said, no, we have to give them only 1,500 or whatever those numbers were. Now, it started there. Now, let's assume for a moment that there was a settlement and the number was 4,000, 5,000. I don't know what the number is. Could there have been liquidity that could have saved ILFS? Perhaps it does. So, I just think that the borrower in the system, the biggest borrower in the system today is the government. He gets the most preferred rates. The government gets the best rates in the market. Can they at least transmit that to the various counterparties? And to me, that would be the number one quantitative easing you could do, because it's your own money coming back to you.
Just wanted to get in your take as well on the interest rate situation. You said that we are going into a lower interest rate situation. We're not seeing that transmission of rates. So what do you think really needs to change on that front for the situation to improve for banks? It's a virtuous cycle.
I think the one thing that has happened is that if indeed the government is stepping out of the domestic market for borrowing to an extent of $10 billion and goes overseas to do the same, is it right that there is more money now available to the system here, even more than it was available earlier? Somewhere along the line, risk has to come back. You need 1 or 2 banks, maybe the biggest in the business, to turn on and say, we are restarting NBFC lending. Maybe we are restarting, XYZ sectors that we pull out. Why can't, for instance, the biggest banks go out there in the system, go out there and lend to real estate projects again, to start saying those that are 20% about to be completed will get the last mile funding, notwithstanding what has created this delay, and start getting projects completed. Let credit availability enhance to at least selective sectors.
So there is a way out for these NBFCs.
It has to be the willingness to do it. Yes. How else can it happen? If they say, my sectoral caps are full for NBFCs, my sectoral caps are full for real estate, then where's the money going to come from?
But I'm just wondering, post the budget, post everything that's already been asked for in the wish list, this is what we've got, what they've done in terms of monetary
I don't think
easing.
the budget was meant to give any of this.
So you're still hopeful or expectant that we may see
Not hopeful. I'm not hopeful. I think the question asked was what can be done.
Yeah. So okay.
I'm scarcely suggesting that any diktat comes from Delhi that this should happen.
Yeah.
I personally think the only way it can move forward, please understand the entire lending to the NBFC sector. It's a question of the weak ones fall first, the strong ones fall later. But everybody will fall if this scenario continues. I mean, if that's not a Cassandra and a prophet of doom, nobody is. But I'm telling you, you have to restart lending. I mean, this cannot be overstated. If you do not do it, it's a recipe for greater NBFC NPAs. And that will have a absolute cataclysmic effect in the market. I mean, it's not me suggesting, maybe I'm using stronger words than I need to under the influence of no coffee this morning, but I think the reality is everybody needs to smell the coffee. This is getting much worse than it has been. You know, there are big private sector banks today that are struggling for capital. I mean, there are names and names and names, but seriously, I think this situation should not get out of hand. We can say the real estate is a problem. Everybody says it. It will become a self-fulfilling prophecy, if it not already is.
Are we likely to fall further in a tailspin? Because, well, the recipe is that you have to start lending. It's not going to happen. Let's be realistic for a minute here, because those who have ability, they don't have the will. And for those who have the will, they do not have the ability. We've not seen a very pronounced slowdown in FMCG. We've not seen a pronounced slowdown in consumer durable. Autos, barring this 6-month patch, auto sales last 2 or 3 years have been okay. If the farmers are not making money, guess what? The Uber and the shared economy and the Swiggy walas are making money.
Are they?
Well, they're making money in terms of creating a job. You're creating a job, you're creating employment.
Today on the back of joblessness, today it's very clear that recruitment follows wealth and prosperity.
Yep.
If the corporate sector feels good, they recruit. So the issue about going after, for instance, every company that has a default, without even determining necessarily whether the default is because of business reasons or otherwise, you hear of SFIO probes and, you know, the ED and the regulatory agencies getting involved to see if there's a problem. And now people, to cover themselves, are calling everything willful, or they may call, you know, just to cover their own positions, as it were. Bankers will take that stance. Were that to happen, you're talking about industries that will actually lose jobs. The collateral evidence today, I mean, one airline collapsed. It's not just the 16,000 people or 18,000 people who worked there, but probably 150,000 people who worked in industries like catering, industries like, you know, engineering, industries like, you know, the support staff, whether hospitality, whatever. So, you know, the impact is huge. So maybe this is a cleansing, which, yes, 2050, you look back and say, fantastic, this was the period we cleansed. And to that, hats off. I think to an extent, the will that the government is showing is incredible. Is there a pain that is pretty dramatic that we have to, you know, absorb in the short run? I think none of us have seen this happening. It's first time since independent India that this kind of a cleanliness drive, I mean, to my mind, this is the true Swachh Bharat Abhiyan, as it were, which is that you're attempting to clean India.
It's good on paper, you know, Jakes, but the point is when you're cleaning it, the entire supply chain gets disrupted.
But it is happening. That's what I'm saying. So are we supposed to carry a moral cross for everybody who's not been quote unquote clean, and therefore we must decimate them? The jury is still out on that approach.
Okay, so if you're an investor, can I safely say, and again, this is coming because I'm aware of what you know, the backdrop of this thought is, just for the viewers, does it make sense to, let's say, now buy market leaders in the disrupted sectors?
I don't think so.
It's too early to do that.
See, flight to safety, if it's a flight of consensus, can never make you money. Let's be very clear. Today, if there are 100 people in the market, and 90 are feeling the way we are, 8 are not putting their money to work, and 2 say, I'm going to go out and you know, invest selectively in stocks that people are not looking at. Take a guess 3 years from today, will the 2 have made money or the 90 have made money? Yeah. Now, there is a period when you have to have capital conservation, but there is also some risk taking. So the 2 who are taking a risk to invest are actually acting completely contrarian, and therefore need to get rewarded for their risk, as it were. I'm not saying everybody can do that. The fact is people are not doing it. And to the extent you can, you have a greater chance to make money, because the markets may have factored a lot more in the short run than you and I imagine. That's the limited point here. Therefore, I'm saying, is it very easy for me to say, where is it that you can make money? People have talked infrastructure. The government will spend. Yeah. Today, the entire private sector spending is now being replaced by public sector spending. So where are they spending? They're spending on a bunch of things, notably that which links the rural economy to the to cities, etc., which is things like roads, highways, physically to improve ability of people to travel for jobs and so on and so forth. So the water, water and transportation of water is a big beneficiary industry, as it were, which because it can actually reach the masses and so on and so forth. So that's one industry. So companies that are on the water and pipes and etc. could be big beneficiaries of orders that could come through. Whether it's profitable or not, that depends on individual balance sheets. Road building companies, we are extremely bullish on that space because we can see activity happening. But my contra to that is, will the NHAI pay on time? Will banks, help in financial closures on time? Those are adjunct questions to this. So my point is, somewhere you need to take the call and say, where real assets are there, like real estate, etc., let's go out and at least take the step forward. It will break the logjam. That's important.
Okay, Jake, so appreciate your time. Let's hope the next time when we meet, we are talking about slightly more,
and you come with
sunny
coffee.
Things.
Well, coffee is a different thing, but I think, at the risk of repetition, we need to wake up and smell the coffee. I think, theory is one thing. I think it's hurting big time in the economy today.
Okay.